Okay, a little bit of adjusting going on. So good morning, everyone. Great to welcome you to the second day of Reset Connect. And we've got a very exciting panel going on today. We've got investing across the spectrum of capital. And so what we're going to do is we're going to take you through the journey of not only impact investing, but also talking about the spectrum of capital. We've got a fantastic panel that's going to sort of detail it, dissect it, and sort of really share their own insights and expertise around that area. And we want it to be a really, really interactive session. So what we've done is we've taken the spectrum of capital and basically gone across the macro view and then want to go into the micro view after that. So the session is basically structured into two sections, really, and we're sort of going to spend the time around that and across that. So the macro view, we're going to have insights and have the speakers go into that in far more detail. Then we're going to take Q&A. So you've got an opportunity to ask questions at that round and just come up with things that are important to you, areas that you want to explore further with all of our expert panel. And then we're going to go back into a panel conversation, talk about the micro aspects of investing across the spectrum of capital. So, and then close out with a Q&A, so there'll be two opportunities to ask questions. So that's the flow of the session that we've got. Macro, micro, across the spectrum of capital. And so with that, what I'd like to do is I'd like to kick off with defining a couple of things just to start our session. So I've just drawn upon the Global Impact Investing Network, or GIN, for their definition of impact investment. And so GIN basically define it to be impact investments are made with the intention to generate positive, measurable social and or environmental impact alongside a financial return. And so what are we talking about there? So there are a few characteristics which are really worth highlighting. So we talk about intentionality. So basically the idea that investors are keen to generate positive impact through their investments. For example, renewable energy projects would fit into that category. We also talk about impact investing having, a very sort of detailed impact measurement and management process as well. So the commitment to measure and report on social and environmental outcomes. So that's also a big part of impact investing. An example I've got here is using AI to track carbon reduction in portfolios, for example. We've also got the additionality. And so the additionality talks to the fact that, capital is flowing into investments which may not otherwise see that capital. So the idea that it's an addition, there's a meaningful contribution that's being made. And we can see that those kinds of examples within healthcare solutions in developing countries. And then we talk about materiality. So ensuring investments address significant and relevant social and environmental issues. And so obviously, clearly, climate change and social inequality fall into those categories. So we've talked about impact investing. We've talked about basically going across intentionality, the impact management, measurement side of things, the additionality, as well as the materiality. And so now let's quickly look at the spectrum of capital. And so the spectrum of capital is really the trade-off between financial returns and the impact that's achieved. And it's literally going across that spectrum. So you start on one side with, traditional investing, and that really has a big, strong focus on financial returns. And so the majority of the investment community have been investing, very traditionally, and with a very large focus on financial returns. And then as we go across the spectrum, we go across different investment strategies. So everything from screening of certain industries. So we can think about weapons, tobacco, alcohol, those kinds of strategies where those stocks and industries are screened out of investment portfolios. And we go across into more nuanced strategies where sustainability considerations are incorporated into the investment decision-making process. So we think about sustainable and or ESG integration, for example. And then we talk about impact investing. We talked about the major characteristics around impact investing. And then finally, we go across to philanthropy, where philanthropy is, there's no expectation of a financial return. Basically, there is a focus on the impact or the outcomes but by which grants are made by foundations and or other philanthropic donors. So that's the spectrum of capital, and we're going to be basically exploring impact investing across the spectrum of capital. So with that, what I'd like to do is I'd like to ask the panelists to introduce themselves and share the role that they play across the spectrum of capital. Would you like to lead off, Cliff?
Okay, so I'm Cliff Pryor. I have been, until recently, CEO of the Global Steering Group for Impact Investing, GSG Impact, and am now advising a range of impact-oriented organizations. Thank you.
Good morning, everyone. I'm Sarah Teacher. I'm co-CEO of the Impact Investing Institute. We're an independent non-profit whose role it is to accelerate the growth of the impact investing market in the UK and globally. And we do that with a broad vision to change and challenge the broader financial system so that it centres social and environmental priorities.
Hi everyone, my name is Mahima Sukhdev. I'm the Chief Growth Officer at Just Impact. We are a leading data and analytics provider working with companies and investors to help them measure and value the impacts that they're having on the environment and on society, and also to quantify their risks and opportunities associated with that. Because we're a data provider, we sit across, dare I say, the spectrum of capital and run underneath it to power all the analytics.
Great. Good morning, everyone. My name is Richard Gillam. I work for Stewardship, a Christian charity based on the donor-advised fund model. We work very closely with philanthropists and the causes that they support, with a history dating back to 1906. In terms of my career, it's really been a move from the left of the spectrum of capital to the right-hand side, where I am sitting in philanthropy. Currently, most recently, I was a wealth advisor working with high net worth clients, advising them on impact and sustainable investing.
Hi everyone, my name's Ben Constable Maxwell. I work at M&G Investments, and my role is to sort of lead and coordinate our impact strategy at M&G, which is a large UK-based but global asset manager that manages pensions and savings investments for a very large range of clients around the world. And my role is to really, as I said, build impact thinking and practices into our approach at M&G to tackle both social and environmental problems, but also to deliver a strong return in doing that.
And finally, my name is Aaron Kelschker. I'm the head of Sustainable Impact Investing EMEA at Invesco, which is one of the world's largest asset managers. And I'm also a board member and charity trustee for Philanthropy Impact. So just kicking off the session, Sarah, it'd be great to hear your thoughts on how we're going to move impact investing from being niche into the mainstream.
Thank you so much for that, Aaron. And thank you also for defining impact investing very helpfully and situating it on the spectrum of capital. So at the Impact Investing Institute, we obviously believe in the growth of this field, but this field has been growing for about 20 years. So if you look broadly today, the global market size of impact investing, that intentional, measurable finance that Aaron articulated, it's now a $1.571 trillion market. In the UK, it's now a £77 billion market. And both the global and national markets have seen really promising annual growth rates. So the global compound annual growth rate of the impact investing market was 14%. In the last 3 years in the UK, it grew 10% a year. And if you marry that across broader investment management performance, you can see that impact investing is growing at a rate that's larger than the kind of the more commercial strategies. And that's because impact investing responds to social and environmental challenges. So many, in 2015, the Sustainable Development Goals were laid out the kind of 17 priorities for global development. The OECD in 2022 sized the financing gap from where we should be to where we need to be, and sized it at $4 trillion. So there are these huge needs from inequality, from biodiversity, from climate action, and those huge needs present both opportunities and risks. So impact investing is basically a financial services response to those massive social and environmental challenges. In addition to which, there's a spirit of the age change. So if you look at Gen Z, at millennials are now, we used to be cool and young, and now, we're sort of early middle age with small children. I'm just sort of talking about myself there, but basically anyone 40 years old or under is completely committed to climate action and wants to see purpose married with profit making, because we've basically been raised looking at environmental and social externalities and recognizing that there are some failures in capitalism that need to be recognized and rebound in. And what we see now in the City of London, where much of my attention is spent, is that mainstream investment management, what used to be a kind of boutique niche sport, to Aaron's framing, is now increasingly in the mainstream. So, Ben's here from M&G, a major institutional investor running strategies, multi-billion pound strategies, delivering impact. Aaron also representing that from Invesco. So the City of London now, in every corner of high-quality investment managers, there are impact professionals running these strategies, and the appetite from asset owners is ever growing. So last night I had a dinner with a bunch of family offices. These are private wealth holders, which many of whom in the room had over £500 million worth of their own kind of family assets, committed to bringing their values across their investments of investing behind social and environmental long-term opportunities. And it's not just the private wealth holders either. So the local government pension scheme is increasingly looking for impact. The Church Commissioners' £9 billion platform is looking for impact. So this is a growing area that's gone from a niche to just touching the pioneering mainstream, and given the market fundamentals, is only set to grow.
Thanks very much, Sarah. And Sarah's touched on some great points there. Just talking about the value of the overall impact investing market at 1.5 trillion as of the moment, as per the most recent research has shared. But we've also seen an ESG backlash that's coming out of the US. And how is impact investing and sustainable investing faring amidst this ESG backlash? It'd be great to hear your thoughts, Cliff and Mahima.
Well, yeah. So where are we with ESG? Let's just have a look at that as well as the impact side. So ESG is a risk reduction approach for companies, and to an extent looking at sustainability as well. Impact investing is that much more intentional piece. Having said that, impact investing is never perfect. For example, you were talking about different possibilities. Let's say we have new hydro or wind turbines. Well, that's a great thing, but there was quite a lot of concrete made in those, and quite a lot of steel and so on. So there's never a perfect. It's always a balance. ESG is very much, though, on risk reduction and very much focused on the E of ESG. The backlash. Well, look, the backlash is there, but there's, roughly speaking, 36 trillion of ESG-framed organizations. So that's way bigger than the amount of impact investing. So that's important. Yes, things have gone dark in the US, but there doesn't seem to be much data to suggest that any less action is being taken. So it's more of a culture change rather than a technical change. If we step back a little bit from what's happened in the EU is planning, it seems, likely to reduce some of the burdens, ESG-like areas, because their initial regulatory system created very heavy burdens on SMEs, and that was reducing the innovation side. So, you get, okay, one place, another place. Let's look at the Gulf. The Gulf is quietly developing sustainable investment. If you go to Singapore, absolutely booming. If you look at Japan, even faster development than in the UK. So even China has identified 3 of its major financial centers to test out ESG and sustainability work. So the geography is definitely changing. What's more significant and more and more of the investment opportunities that you naturally get create sustainability and impact, because that's where most of the areas are. So if you think of things like health and aging society and education and so on, well, those are inherently impactful. I would love to see a time when you didn't actually have to say impact or ESG or whatever, because you are focusing mainly on the issues that are most important for our climate and for our people.
Really well said, Cliff. Thank you. And I'll just build on your points and maybe start off by taking us down sort of a little bit of a history lesson. So many don't know this, but the concept of ESG actually emerged from a paper published in 2004 called Who Cares Wins. And in that paper, they framed environment, social, and governance factors to be considered alongside financial performance as a way to measure how companies are acting in the world. And the way in which they framed it was a construction, a framework, principles, pillars, but what they didn't ever intend to do was combine E, S, and G into a composite score, quite shoddily if you ask me, and that's what a lot of the major data providers and rating agencies did in the years to come, and provide that score to investors who were then looking to use it to analyze risk and measure impact. Now, that happened for a happy 10 years until the ESG backlash started. And now what we find, and in the last few years, Bloomberg came out with a critique of ESG and said, hey, you're actually not measuring impact. And so finally MSCI, who is one of the biggest ESG ratings and scores providers in the world, came out and admitted, yeah, we actually don't consider impacts or contributions to society. It's purely a risk filter. But the problem was that it was sold as a metric to measure impact. And so part of the ESG backlash, I really do believe, is justified, because investors who've bought, an expensive set of data thinking it's helping them contribute positively to the world and aligning their capital with it are now saying, hey, actually we were cheated. The ESG backlash, as an impact data provider, we've even been part of it. We see impact really as the next evolution of ESG, considering location-specific, science-based metrics that actually help companies and investors move the needle. So in response to the question, the ESG backlash, impact can remain relevant as long as we don't throw the impact baby out with the ESG scores and ratings bathwater, if I may. And I think that we're starting to see now some of the world's largest sovereign wealth funds and wealth managers and the like just shift their focus from ESG scores and ratings over to impact metrics.
And so great to hear your perspective. And you've, both Cliff and Mahima, you've touched on some great points there, talking about the lightning regulation. So EU regulation, which was very comprehensive and challenging in terms of reporting, that has become lighter. So there's been the movements to lighten that. So we've got the EU omnibus, where people would sort of view that as the EU stepping back from the regulatory environment, or the requirements for companies to report on that. And so there are a lot of regulatory initiatives which potentially aren't moving as quickly forward as they were, and or are stepping back, and the EU being one very, very clear example. Mahima, you also touched on a really important point with respect to decarbonisation and portfolio decarbonisation versus real-world decarbonisation. And while within the investment world, portfolios have been on a trajectory to decarbonise, where strategies following decarbonisation have been followed, real-world emissions are still rising. And so this huge disconnect between the real economy vis-a-vis portfolio decarbonisation is also a highly critical and very, very active debate and challenge which we're trying to address. And I guess moving on to the initiatives which asset managers are pursuing within the context of impact investing. It'd be great to hear, Ben, from your side, how you view the sort of the trade-off between impact and financial returns, and also maybe going across asset classes, the way that M&G potentially is viewing the overall impact space across both public and private markets.
Sure, yes, thank you. Great question. Taking the second part first, we believe you can really try and build an approach that focuses on positive social environmental outcomes, that deals with society's big challenges, whether it's climate or waste or pollution or health challenges that we increasingly face as a society and provide a significant burden to cost burden to society, social inequality. We think you can build a strategy overall for M&G through its private assets business, public asset business, equities, fixed income. You can really try and build those principles and thoughts to drive positive change across your asset classes. Now, that's a nice sort of easy thing to say at a high level, as a high level comment, but it's really hard work to work out how to do that for individual funds, for public market impact strategy, which is the one that I'm particularly involved in helping to run. We have a pretty concentrated number of companies that we can invest in. We're trying to invest in companies that are demonstrably, evidentially providing a solution for those challenges that I've provided. It's not about decarbonising the portfolio so much, it's about investing in companies that are tackling and solving the world's problems. And we can apply that sort of similar thinking to earlier stage businesses where we can provide them with growth equity to help them grow before they list into the public markets. And so, a collaborative approach across M&G, working with useful and sort of insightful data from the likes of Mahima's business, collaborating with other organisations through organisations like the Impact Investing Institute and Sarah and her team, that really helps us do this better, work out what the problems are, how to target them with particular aspects of capital, and really sort of take a collaborative internal and external approach to these sort of challenges. But your point about clearly our main role, frankly, and most of our clients would say our primary role is to deliver good returns to them over the long term. So we also have to work out how to balance that social and environmental impact with financial outcomes. Now that's further hard work, but it's our bread and butter, frankly. And really the way we do that is by identifying those solutions that are really solving a problem that business or society needs to have. So in other words, if you're providing a sort of solution for farmers to help them cut their costs, cut their reliance on chemical fertilizers by providing, for example, a biologic alternative, that is solving a problem for them. It's a company that is therefore going to generate, we believe, long-term returns as a result of that. We can invest one more company, maybe in the public sphere, is we can invest in a large global distribution business which is building circular economy practices into global logistics. So it's a sort of share and reuse model where those pallets that you see at supermarkets and in retailers, those pallets are being repaired, shared between the retailer, the consumer goods producer. That cuts a huge amount of CO2 emissions, cuts a huge amount of material use, but it also solves a problem in driving efficiency for Nestle or for Tesco's. So it's all really about trying to align that societal value, societal use with value to the businesses and value to the customer. And then that, in the long term, results in profitable outcomes as well as sort of outcomes for the planet.
Thanks very much, Ben. And it's great to hear that sort of partnering across the journey of a company's life cycle as well, in terms of starting that conversation and developing it, and through the investment and in the stewardship aspects of that as well. It'd be great, Richard, to hear your thoughts on, I guess, the sorts of conversations you're having with impact investors within the context of private wealth, within the context of philanthropy. And it'd be great to hear, obviously, how that, hearing that after hearing Ben's views and perspectives with respect to institutional asset managers. Because private wealth are a very, very large group of stakeholders and investors.
Sure, thanks, Aaron. And I'd start off by saying that values play a really increasingly important role in investment decision making. A recent survey by Allianz, the global insurer, concluded that some 64% of that younger generation make investment decisions based on their values. So we've really come a very long way in the last 10 years or so. I think it's important just stepping back to understand that philanthropic capital that I represent is not a separate pot in and of itself. That younger generation look at impact investing and their philanthropy through a single lens. They look at it through a business or an investment lens, and that is really important to understand. And in terms of that lens, values, whether those are social justice or environmental values, are increasingly important, and they transcend that entire spectrum of capital. They transcend the buying decisions that the younger generation make. They even transcend parenting decisions of that younger generation. So we've really seen a really dramatic evolution in values. I want to touch on one really important point, and that is of alignment. Whether from a private wealth perspective or a philanthropy perspective, there's clear evidence that oftentimes there is misalignment, that from a private wealth angle, a client may have those clear values around environmental issues and social justice issues, but those aren't reflected in their investments. And to give an example, I've seen clients where they've made clear lifestyle changes around fitting heat source pumps and solar panels and flying less and changing their diets and walking to work and so on, sort of good environmental moves and sustainability moves. And yet their £1 million pension is invested in a very traditional fashion. And there's really an opportunity there to align those investments with their values to really multiply the positive impact that they're having. And equally on the philanthropic side, we see that as well, and it's really important to drill deep into the donor motivations. What kind of impact do they want to achieve? What are their true values? What are their objectives and aims and aspirations? And really then to align the causes that they're supporting with a hardwired value system. Thank you.
Oh, that's great to hear. And maybe just ahead of going into a Q&A across the macro views, just to share a statistic with you. So younger generations or younger people are basically making larger donations proportionally as a percentage of their income versus people who are later in their careers and or generally older. So that's an interesting dynamic that within the context of philanthropy and donating towards charities. So we're coming to the end of our macro view on impact investing across the spectrum of capital. I'm just going to open it up to the floor for questions that you may want to ask, and we can probably kick off with taking 3 questions to start with, and I'll open and then leave the panel to answer that. So I think it's probably fast. I'll just come down to the floor. I took this from Hannah Cool, who's from Bankers for Net Zero yesterday. She found it very effective to come in and pass the mic to you. So I'm going to do that right now.
Thanks, Aaron and team. Very well done. My name is Adil Bandelli. I was the program director on the launch of the first ever Lloyd's of London Impact Private Fund or Private Impact Fund, and dare I say it was painstaking and painful, given it was an Article 9 fund. What is your view on the launch of such funds? Are people aware of sometimes these being a needle in a haystack or a utopian ideal, and what are your views on perhaps Sarah and Ben might be best placed to take this one in terms of popularizing the UN SDG and the SFDR with the wider audience, as opposed to keeping it being a very close knit in the investment population only. Thanks.
I'm happy to respond to that, Aaron.
Perfect. So that's with you, Sarah. I'm going to move over to the next question.
Good morning, everyone. My name is Grace Olmendros Castillo, and I'm founder and CEO of Gifted AI. My question is around the mainstreaming of impact investing, because currently or over the last decade, it's been the large corporations, large enterprises who have been participating in monitoring and management of ESG and impact. However, we all know that the success of these big corporations are actually driven by the small, medium enterprises. They are the suppliers, right? So without the suppliers, without the small, medium enterprises, most of them are, what do you think are the changes in metrics that probably need to be, introduced? Because the way that you measure big corporations versus small enterprises are quite different, and they are the actual doers in society. So that's my question.
Yeah. Thank you very much, Grace. Who'd like to take that? So we've got Mahima with the second one. We've got one here, so I'm going to go here.
Thank you. My name is Maria Vieites. I am Executive Director of Social Impact. And I would like to ask quickly about that. So, because in this conference we talk a lot about decarbonization, but inequalities are growing quite rapidly as well in the world. So how do you measure social impact in your investments? Thank you.
So how we measure social impact through investing, that's with Cliff and...
Thanks, Aaron. Hi, I'm Trisha. I'm a consultant. I've got a question about exclusionary screening. Just stretching on some of the points, I think, which Cliff raised, and yourself as well, Mahima, around greenwashing. Just as like with carbon, we've got this idea of scope 1, 2, and 3, and 4 even now. Other areas, there could be a kind of almost a secondary or a derivative or a tertiary kind of impact that happens from exclusionary scrutiny. So how do you kind of capture and manage not just direct companies that are involved, but sort of a second tier and third tier and so forth? Thank you.
So who'd like to take that one?
I mean, I can comment on that maybe with
So
Mahima.
Ben's got that one, and just one final question.
Thank you. Hi, it's Marcos from Net Purpose. I was just wondering, because we were discussing kind of the growth of impact investing and it entering the mainstream, and as much as kind of there are lots and lots of studies always coming about how that's distributed across asset classes, just in your experience day to day, where do you see most interest rising? And is that kind of uniform, or does that differ from who you're speaking to? Thank you.
I can fold that in, Aaron, unless, Richard, you want to comment from the kind of philanthropy, private wealth side.
So brilliant. So I'll let the panel respond to the questions. Thanks very much for the questions.
Well, thank you so much for that question. The Impact Investing Institute's job is to make a big noise about impact product. And actually something that I was chatting to Ben about the other day is that, so one of the pieces of policy that's been introduced is something called the Sustainability Disclosure Requirements. Don't all fall asleep immediately. But one thing that the FCA has introduced is an impact label. And I was saying, there's been a lot of pain as people achieve these labels. It sounds like you still have some bruises on your back, sir, from mounting your own Article 9. And there's not a lot of fanfare on the other side. So I was saying we should have a big flashy party about, a year on from the impact label. But seriously, we need to be much clearer and much better at selling the extraordinary role of this type of finance. It's one of the secret sources of the City of London and an amazing story for the UK more broadly. We, particularly given geopolitical events at the moment, the UK and London specifically is the best place to raise an impact fund, deploy an impact fund. We have 800,000 financial services professionals in this country. And in every one of those entities that those 800,000 people work in is now a corner of really strong practice. So as I said in my comments to Aaron, we're just we're going from boutique niche to the corner of mainstream. And I'm hoping that notwithstanding some of the headwinds that Cliff touched on, that this is the moment of exponential growth, because those wealth holders that Richard's working with, that I had dinner with last night, the alliances, who I think someone mentioned, talking about how foundational these strategies are to long-term performance, because they respond to science and actual social and environmental challenges means that there should be exponential growth. But we have to sell it better, we have to talk better to it. And just a final point on that, we've run a big survey with Ipsos Mori around what we call our investments narratives project, which is why in a world that's on fire, that has this type of finance that could actually contribute amazing solutions to solve some of these challenges. Why are we so small? 1.571 trillion sounds big, but at our most optimistic, that's 1% of global capital markets. So we need to do a much better job of selling. We need to do a much better job of selling to our investment professional colleagues who think this is a cool thing, but don't think it's their cool thing. So we need to describe its relevance, its fundamental role in delivering financial performance, its fundamental role in increasing AUM and fees. And that's the job of the Institute and others and events like this.
Oh, great, thanks very much. And Mahima?
So just to quickly remind folks of the questions, it was about mainstreaming impact and including SMEs in that journey, which I think I'm very glad you asked that, thank you, because it is a very essential component. I actually have heard so many people say, from regulators, by the way, including in the European Union, oh, we can't put this burden of sustainability on SMEs. I actually believe that that's deeply patronizing. A, we cannot solve our climate and nature and social crises without SMEs. They make up the majority of our world economy. And B, every SME I've ever spoken to is actually really keen to get involved and do their bit. SMEs have unique challenges. They are small, they are resource strapped, and they're very, very pressed for time, energy, focus, and so on, in a way that larger organizations aren't necessarily. All we need to do to get SMEs in on the journey is provide them clarity and to provide them access. And by clarity, I mean we have had many rounds of over dozens of iterations over many years of reporting and disclosure standards that have been all over the place. And as an SME, that's just a lot of noise. Companies can afford to follow back and forth where the direction's going at any given point in time, but we just need to provide clarity. We actually don't even need to provide different metrics. We just need to say, these are the metrics, and make them consistent with the big company metrics, by the way, because that universality of data, which I'm happy to speak to in more detail, is very important. So SME data can plug into a big company's data set when they start to report on their value chain. So that's really critical. And then the second piece is access. So the good news is there are a lot of tools. Just Impact actually provides a tool for SMEs to quickly onboard onto their journey. It doesn't cost hundreds of thousands of dollars or even tens of thousands. It's quick, it's easy, it's doable, and the main thing is being able to provide that access and making SMEs aware that those tools today exist for them. But yeah, I'm really, really glad you asked that question.
So Cliff, would you like to go next?
Yes, I think it was over here. Yeah, I can see you through the gloom there. And this question about the social factor, it is much more complex. Of course it's much more complex, because even if you just took one thing, let's say a decent job, but how did you have to come 5 miles to get to your job, or could you do it closer? Did you have the opportunity for as a woman to take that job, or is it always the men? What about global minorities, et cetera, et cetera, et cetera? And that's just one little question. So it's a very, very complex area. Most impact investors are focused on a small number of those areas. But to look across impact investing as a whole, you need some kind of framework. And there are efforts towards that framework. The ISSB, the International Sustainability Standards Board of this is part of the global system. It's partial. It's only in its early couple of issues. Plenty more to be looked at there. And then you have quite out there opportunities. The IFVI, the International, hang on, if I get this one right, is for valuing impacts. And that has looked at the decent job area, and it's starting to look at some other social areas. It is still very complex, and of course it's cultural. If you're thinking about gender issues, they're very, very different cultural takes across the world. So this is always going to be tricky, but it shouldn't stop people from doing good stuff. You know, if you are a company that is hiring, think about the population that you're hiring from, about the gender, about disabilities, etc., etc. You can do quite a lot without having to be perfect. If we try to aim for perfect, we'll never get there. We can work on this, and as I was saying earlier, more and more of the opportunities for investment are positive impact, just in the nature of what's happening with the world.
Richard, please go ahead.
Yeah. To that excellent question about where is that demand coming from impact investing. I mean, I certainly have seen it on the private wealth side from the work I've done with high net worth clients. We know that over time, surveys have shown that multifamily offices is going to be another space where there'll be a really significant take-up on impact investing. From a philanthropic side, at Stewardship, we're moving more of our investments into impact investment solutions. And we're seeing our philanthropists more and more interested in creating both impact through the grant making, but also impact through how their contributions are invested over time to grow in a tax-free environment. So in the US, where you've got a much larger market for philanthropic capital, we see much more focus on impact on both sides, on the grant making side and on the investment side. And we're starting to see that trend evolve in the UK, and it's very exciting indeed.
So yes, I'm going to be greedy and answer very briefly or touch on one of the other questions as well, but I think the growing appetite for impact investing, which you've just sort of clarified, Richard, and others as well, is, we're really encouraged by it. These are pretty difficult times for sustainable and impact investing, but we're seeing some of our biggest allocations of capital from our underlying clients, particularly actually big pension funds, particularly in continental Europe, but also in the UK, who really want to do good with their capital, with their investments, but only on the proviso that we can deliver those strength of return. So I think that, it seems a bit like doom and gloom sometimes at the moment, given all the geopolitical backdrop, but we're seeing really encouraging allocations and commitment. And then the quick question about exclusion, and maybe it's sort of second order and third order impacts. And it's a super complex question. I'm not going to try and nail it right now. But two things I would say is that I think all positive impact investing does start with what are the negative impacts, obvious negative impact areas that you should be avoiding. So, we constrict our portfolio intentionally and by design because we don't want to be investing in X, Y, and Z company that are clearly doing damage to the planet or to its inhabitants. But then, it comes to selecting those companies where we think they're having a primary, clear, positive impact. But what's really interesting about impact investing, and it also touches on the social impact side of things, is that you can be investing in a business which is primarily there for environmental, climate-related impact, but it can touch on tackling conservation of nature, or it can also support sort of economic empowerment of local communities. So there's always a complex mix of positive and negatives. You try and rule out the negatives by design, and then you're often really encouragingly surprised by the positives that may emerge even outside of your primary focus.
Thanks very much. And so I've just been signaled that we've got about 15 minutes left, and I'm really keen to touch upon how we scale impact investing and talk about some, moving from the macro to the micro, talk about some real world examples, and then also talk about maybe some environments, some policy enabling environments. I'd love, Sarah, if you can just touch on policy enabling environments. But before that, just asking Mahima and Cliff, just talk about the real world examples of the scaling of impact investing that you've seen, that you've been involved with.
I'm happy to kick off. So we've heard, I think, Sarah, you put it really well, we're still only at 1% in terms of impact investing as a percentage of the total global asset pool. And then we've heard, Ben, you talk about mainstreaming your impact strategy across from just your impact portfolio, impact investing portfolio, to the rest of your portfolio. As a data provider, we see data infrastructure and impact data infrastructure specifically being key to that sort of scaling. Right now, impact data is unfortunately still a bit of a cottage industry, dare I say. It's handcrafted, it's non-standard, it's not necessarily connectable to the rest of the mainstream value chain. And so if we have impact data that is universal, that is auditable, and is connectable into standardized workflows, you can really take that impact investment piece and start to look at how does all investment actually have an impact. And the quicker, you need that data foundation to be able to do that successfully. To give you a couple of examples then, we work with Microsoft, for example, to quantify their impact for all their social programs, for the gentleman who asked the question about social. They use the standard IFVI framework, which you mentioned, Cliff, to quantify that in economic terms, so accessibility grants, apprenticeship programs, tech skills boot camps, all of that using a universal set of metrics. We managed to discover that Microsoft, just through the 17 programs we've measured so far across the UK and the US, create $1.7 billion worth of social value. That's not for the company, that's for the societies, communities, and employees that they're investing in. And that was value that hadn't been measured and recognized before, but they've used that universal standardized framework that IFVI provides. And it helps them, right? Because they are able to scale their investments in impact. They're able to win government tenders because the government's requiring increasingly in the UK for companies to demonstrate social impact. So that really, really is essential. And then on the investor side, I can quickly add one more example. Norges Bank, which is the world's largest sovereign wealth fund, owns 2%, I think, of all of the world's listed equities. They've recently published their Climate and Nature report, which is full of impact metrics. And again, they're using standardized frameworks like the IFVI, quantifying their natural capital impacts. Same metrics, by the way, same approach, I should say, as Microsoft is using on the corporate side. So you can see that connectivity building that you need to be able to efficiently scale that system. And Norges Bank, again, is using that data across their engagement teams, across their risk teams. They're using it to, I think last year, just 500 companies that they engaged with around their impact, and then also using it to make risk-related decisions. So they divested from 10 companies, the top 10 most risky companies, as well as guiding positive impact investment, which comes back to what you were saying, Sarah, to invest in renewable energy generation assets to the tune of 2 gigawatts, I believe. So all of that to say, when we have that scalable impact data infrastructure, we can mainstream impact strategies and impact actions successfully across the entire spectrum of capital.
Brilliant, and a fantastic way to scale. And over to you, Cliff.
Well, look, I think that was a tour de France. Thank you very much indeed on that. But so what does this do? It does credibility. It does replicability. It gives verification. And it's not just about what you prove by the data. It's how you can improve with the data. And that's okay. So that gets very complicated. We have AI now, and I think we can put that together. And I think, around the conference hall, there are a number of organizations there which are working on exactly that, which makes it much more feasible. Thinking of some examples, I think, actually, here's a really big example. About 4 years ago, compatriots from Japan, the UK, and France, civil servants, all working on quite how do we handle these kinds of impact and sustainability rules without actually having a very private meetup. That wouldn't have come out quite so well, I think. Thinking in sub-Saharan Africa, the work across 3 different countries with 3 different models, but all trying to create wholesale pools of impact in their own country could not have been done without the data and infrastructure around it. So, some really good things have come out of that.
That's some fantastic real-world examples. Sarah, it'd be great to hear about, policy and how policies can enable the scaling of impact investment. And also maybe, Richard, to hear from your side as well with respect to how to get financial advisors more motivated and action further with their clients or along the lines of impact investing.
Well, I've already been a big drum banger for how brilliant the City of London is and how brilliant the UK is to be an impact investor. So government has a really important role here, but also government has a really important, impact investing has a really important offer to government. So if you are Keir Starmer and Rachel Reeves and you're in a fiscally constrained environment with chronically underinvested public services, guess what? Private capital that delivers public policy outcomes, which is what impact investing is, it's interested in health outcomes, it's interested in opportunity, it's interested in green growth, then these become the natural partner of a UK government that needs to crowd in investment sources, not from its own tax-funded balance sheet. So one of the really exciting initiatives that we're involved with at the Impact Investing Institute, acting in support of something called the Social Impact Investment Advisory Group. It has two key elements to it. One is a specific social investment vehicle, which will be announced in mid-July. It was kind of trailed in last October that they would be working on. It got a mention in the spending review. You can see how much I've been poring over these documents, but it will be officially launched in mid-summer, and then across the autumn there'll be a set of recommendations that will go to the UK government about how the government can better interact with impact investors to get money moving to the issues that matter to the people of the UK. So how can we have a great health system where mental health and waiting times come down? What is the role of impact capital in service of the NHS's prevention goals? What is the role of impact investing in getting in place green infrastructure that enables us to be a green energy superpower? So this government is very thoughtful about how it can combine and enable impact investing. So should be some good news soon.
Great to hear about all of the initiatives taking place in the UK, and again, would echo those sentiments around the City of London, looking towards taking global leadership within sustainability and impact investing. Richard, how can we work with financial advisors within the wealth and the philanthropic community to scale impact investing?
Great question, Aaron. Financial advisors have such a critical role to play. There are clearly some obstacles because they're not having those impact investing quality conversations to the degree that they should be. And so let me address, what are those obstacles, first of all? Well, there's knowledge and uncertainty are lacking. Oftentimes, there's a sense that maybe it's easier not to talk about impact investing and indeed philanthropy. I'm going to group the two together. Secondly, incentives. There's a misalignment often of incentives. Incentives tend to be very short-term, and in investing in these areas can be a longer-term pursuit. So having that longer-term lens is really important. And then there's a misunderstanding, and I've seen this through my career, for an advisor to talk to their client about environmental issues if they're interested in impact investing in that area, or indeed environmental philanthropy. The advisor feels, I perhaps need to be a climate scientist in order to do this. And that clearly isn't the case. They need to have a meaningful conversation around values and goals and aspirations and what the client wants to achieve, and then pull in the subject matter expert to go deeper. So let me just sort of bring it round. I think advisors have a critical role to play if they do talk about impact investing in a much more holistic sense. Then the benefits are enormous, both for the firm and for the advisor themselves, in terms of reputational, client retention, much deeper, stronger, more meaningful client relationships. So the benefits really are very significant indeed if they can do that. And finally, Aaron, I just conclude by saying that that next generation where those values are much more hardwired, if the advisors aren't speaking to the younger generation, then there's significant business risk because they're not going to get the client around the table to talk about financial planning or tax planning or estate planning, pension planning. These are really dry subjects, but talking about motivations and causes and impact, those are really exciting topics, and that really will engage and energize multiple generations. So not only is it absolutely the right thing to do. It's also commercially the right thing, and really will future-proof those advice businesses. Thank you.
Thanks very much, Richard. So we're just coming towards the end of our session. So we're going to squeeze in one last question before the panelists will share their key takeaway for you in around 30 seconds. So we have time for one last question if someone would like to ask.
Hi, my name is Ulf Leonhardt. I'm running WaterTech funding firm. Impact is like a buzzword. It's a very Give me one example of a technology you consider impactful, you're aware of, say a company, a technology, would be interesting. What your meaning of impact?
Would anyone like to go ahead? Ben, please feel free.
I mean, I can mention one. One is a company which we've invested in, provided growth capital for it to grow its business, and then it graduated into public markets. So our public market funds have also invested. It's sort of nanopore technology. So it's a company called Oxford Nanopore. It helps to, very simply and in very brief, without giving it any of the credit it deserves, it helps to speed up diagnostic and therapeutic solutions for a whole range of different health challenges. You can also, to those sort of secondary impact points, you can use it to sort of preserve or help with biodiversity conservation by looking at the genome of different biodiversity aspects and understanding what's damaging them and how we can tackle those sort of nature degradation challenges. So that is a health-related technology that is really driving positive health outcomes and positive biodiversity outcomes, and it's a company we can invest in and help grow.
That's a great example, and there's many, many more across multiple themes, multiple sectors that we can spend a lot of time talking about. But we've come to the end of our session, so just prior to closing out, it'd be great to hear final thoughts or just maybe one-liners of what our panel would like to leave you with. So maybe kicking off with Ben and moving across and closing out with Cliff.
This is a bit cheesy, but there's a great song by Leonard Cohen called I can't remember what it's called, but there's a line in it which is that there's a crack in everything. That's how the light gets in, which I think is a great sort of way of thinking about the moment. We've got really challenging times, but those challenging times, I think, create cracks for the light of impact investing to get in and help solve the problems we've all been talking about today.
Thanks, Ben. I just, by closing, want to just emphasize the integral role that philanthropic capital has in the context of the spectrum of capital. Philanthropic capital is patient, it's long-term, it's altruistic. It's got many qualities. It can work in tandem with other forms of capital. But in terms of filling the funding gaps, there's one key quality that really stands out. And that's the one that I want to leave you all with, which is the ability of philanthropic capital to unlock markets.
Maybe I end with a bit of a plea, which is alongside thinking about impact investing, please also think about investment impact, because all investment has positive and negative impact. That's a really key sort of transformation that we're trying to achieve. Because today's impacts are tomorrow's risks, and tomorrow's risks are day after tomorrow's losses. So we need to be able to bring today's impacts, the conversation around impacts, and connect it up to losses. And we can do that using impact data that's universal. We can do that using impact data that's auditable, and we need to do that using impact data that can connect across the whole spectrum of capital.
Just building on exactly what Mohini said, in 20 years' time, we will think it was absolutely insane that the social and environmental consequences of our investment decisions were treated as externalities and weren't part of a holistic decision. Finance has always evolved. The concept of risk didn't used to play a major role in how people accounted for and managed investments, and now it's a central principle. Impact is the third prong of the stool that ultimately in the next 20 years will be foundational to how we think about our job as investors. And in so doing, we'll start to bring the investment allocations in step with social and environmental realities. As someone said to me last night, investors are architects of the future. If we put money places, they grow. If we don't put money places, they don't grow. And so it's within our power to start using an impact framing, step into our responsibilities of architects of the future and think about what's the world we want and what's the role of investment in that.
Thank you. Look, the backlash isn't just the US. The backlash is across the world. The backlash is a real problem. Why? Because we're throwing net zero at people, which is not the language that the majority of the population hear. What we need is the SMEs, the startups, and the supports, the impact investing supports, to be able to provide people with something that is just so much better, so much quicker, that the backlash just vanishes. That's what I think is the most important thing. If there's one thing I would want to change in the UK situation, it is the start. Trying to raise money for the start of a new SME is almost impossible in the UK. We're very good at the middle, we're not so good at the top, but we really need to get that SME started. Thank you.
Brilliant. Thanks very much. And just, I guess that the final message that I'd like to leave you with is to thank my panel. So Ben, Richard, Mahima, Sarah, and Cliff for sharing some fantastic insights. And just leave you with a message that I think it's a conversation that we're all involved with. We're all stakeholders too. And it's really sort of driving that collaborative change and everyone, all of us playing our own roles in that within the context of the value chain that we're all involved with. So a lot of thinking is moving in that direction, and I guess in many ways, stay hungry and be the change that we need to drive. So with that, closing out this session on impact investing across the spectrum of capital, and thank you very much.